traders typically fall into one of three categories when it comes to the VIX. Either one, they understand what it is and how to use it, and they use it all the time, meaning every day. Two, they've heard of it but don't have any idea how to use it. Or number three, they have not heard of it nor do they know how to use it. And it's surprising actually how many investors, particularly professionals, fall into the third category. It's actually very common for investors not to understand what the VIX is, much less how they can use it. And although it is calculated based on and reflects sentiment in the equity market or the stock market, it's something that's extremely useful for investors in any market. So whether it's equities, bonds, commodities, Forex, if you know what you're looking for, you can use it in very advanced ways. But what is the VIX? And can we use it to create trading opportunities? Can we use it in our daily investing? Can we even invest in the VIX? Well, the answer to those two questions is yes, we definitely can. But before we can jump into that, which are actually the subjects of the next two articles, we're going to need to understand what really is the VIX. There's a lot of misconceptions about it, and we really need to understand what it actually is so that you can start to understand what is it telling you every day. So the VIX is really a measure of expectations. Now, investor expectations, in fact. So, but expectations of what exactly? Well, it's expectations of volatility. So now, one of the things that you need to understand is that volatility is directionless. What we mean when we say volatility is we're just talking about what do traders anticipate about the market movement, up or down. How far is the market likely to move in the near term, let's say. In fact, the VIX gives us an annualized number that represents what traders think the market volatility is going to be like over the next 30 days or so. So let's use the example. Today, right now, the VIX is reading about 30. This really, one way you can look at it is that it's kind of like saying 30%. What this means is, I mentioned it's an annualized number, which means that if you were divided by 12, you're going to get about 2.5%. That 2.5% means that is about how much? That's about the range that traders are anticipating that the S&P 500, a general stock market index, is likely to move up or down. Doesn't really matter, up or down, one direction or the other over the next 30 days or so. That means that essentially they're anticipating that the SPX, for example, could range anywhere from about 934 to 888. So somewhere in this range, there's a fairly high level of confidence that the market's going to be in that range over the next 30 days. Now, here's how that translates into, this is where that number comes from and how it translates into information for investors. We look at this number and we watch as this number goes up or down. And it's charted just like a stock or any other index. So it might be 31% tomorrow. Might be 28% tomorrow. Because what it's graphing is, the way this translates, or the way that it gleans its information to be displayed as the VIX, is it's looking at option prices. Because imagine that you're an option seller, and you're selling options on the S&P 500, so index options, and you're anticipating that volatility is going to be very high over the next 30 days. You know, you're a seller, so that means that you're going to be incurring an obligation when you sell those options. So if you think volatility is going to be really high, you have no idea what direction it's going to go, but you think it's going to be pretty high, there's a lot of announcements, or there's a lot of uncertainty in the market, or whatever it is. Are you going to ask for a lot of premium or a little premium? Or you're going to ask for a lot of premium. Now, at the same time, option buyers are going to be really interested in buying options, because if they think that there's a lot of volatility in the near term, that's good for option buyers. They can make a lot of money when there's a lot of volatility. So that drives option prices up. So when the VIX is going up, that means that volatility is anticipated to be rising. Good for option buyers and can be good for option sellers, but they're going to need to get a higher premium for the risk that they're sustaining. So option prices are going up. The same thing is true if investors don't think that volatility is going to go anywhere. If they think volatility is going to be pretty low, I mean, it can get down below 10 easy. It's not always above 30. In fact, this is actually historically a very high reading, 30 right now, even though it's been coming down for a while. So when the VIX is coming down, that means that traders are anticipating less and less volatility. That means that buyers are going to need to, they don't want to pay as much because they're not expecting the market to move as much, and sellers are sustaining less risk, so they drive that down. Now the reason why this kind of movement, this downward movement on the VIX is considered bullish and upward movement on the VIX is considered bearish is because of the nature of volatility itself. If you've ever heard the adage that the market doesn't crash up, it only crashes down, well, that's true. So big unexpected volatility is typically downside volatility. So that means that when traders are expecting a lot of volatility, there is a little, even though volatility itself is non-biased, there is a little bit of trader bias to the downside, which means that when you're looking at a trend of the VIX, so in fact, let's look at a chart. Now this chart is pretty, this is kind of unprecedented territory on the VIX here the last year or so. Because when the market started to crash in 2008, the VIX went through the roof. The trend overall was up because the market was crashing. That volatility was just going crazy, and it's a perfect example of the kind of volatility that would drive those option premiums just through the roof. At the same time, when traders started to become a little bit more confident, things started to look pretty good, so we're talking about the middle of March in 2009, we start to see the VIX really start to come down because they're not as concerned about volatility. And sure enough, the rally from March through May or so in 2009 has been full of very small days. It's just been more up days than down days. So we've had this nice little uptrend, and we can kind of see how volatility works. It tends to be under more control when the market's going up, and out of control when the market's going down. And that's why a rising VIX is usually considered bearish, and a falling VIX is usually considered bullish and a good thing. Now, so you understand a little bit more about how the VIX works. So this is how it's calculated. It comes from option prices. It's a measure of investor certainty or uncertainty, if you will, about, or their expectations about volatility and what they think about the future. And it can tell us a lot about how we should be trading. A very high VIX means that we're trading a lot more conservatively. We're being a lot more cautious. So myself included, there's a lot of professional investors out there have been focusing on stuff they rarely touch otherwise, things like bonds, and spending a lot of time thinking about, am I properly diversified? How hedged am I? How protected is my overall portfolio? Maybe my cash portion of my asset allocation is a little larger the last year than it has been in the past because we had a high VIX. The VIX was very high. Volatility was expected to be very high. It's a bit of a self-fulfilling prophecy. It tends to pan out. When the VIX starts to fall, we start to get a little bit more aggressive. We get a little bit more ambitious about our position sizing. We're perhaps not as invested in cash and bonds and more invested towards equities and things that are going to participate or that are going to benefit from a rising market. So it tells us a lot about our general attitudes towards the market, but then from here, once we understand what it actually is, we can start to say, okay, well, how could I use it to help my analysis as I'm trading stocks or bonds or Forex or whatever it is? Can I use trading signals from the VIX to identify opportunities in those other markets? Can I integrate it into my analysis? Because it's, unlike technical indicators, it's essentially as lagless as price action itself. So it's it's a technical indicator that doesn't lag by very far, and it gives very clear signals when the other market may be more ambiguous. So it can be useful in that perspective to generate signals that we might not have identified otherwise. And in general, it's something that we can use to get a feel for what's going on in the market as a whole. Where's risk trending? What's investor sentiment like? So we're going to be getting to that, and then we're going to be talking about how could we make money from the VIX itself? How could we be trading that itself as a component of our overall portfolio?